Let me ask you a question. When I say Google or Facebook or Netflix or Amazon, like what do you think about those companies? What is going on with your brain, and what are some of those similarities between those companies? They're not the only companies that have these similarities, but what are some of the similarities between these companies? Now, one of them is that those four companies and a few more are driven mathematically by what they do, right? There's not a brand behind it. There's not a bunch of commercials going out like the 1950s, buy this product. But literally behind those companies is math being worked. It's algorithms. So they're algorithmically driven or mathematically driven. The other thing, which may not be as important, actually, before I even get to the other thing, I want you to know I didn't say technology, because HP is a technology company, Xerox is a technology company, IBM is a technology company, and I don't think innovation when I think of those companies. So it's not that those four companies are technology companies, it's because they are this mathematically driven or algorithmically, that's a hard word for me to say, driven company. Now, the other thing, and where I want to spend some time with this weekly thought with you, is the other thing that I see very similar between them. And it's this idea that they're all aging in reverse, right? Every day, every hour, those companies and companies like them, they're getting younger and stronger and more aware of what's going on around them. And it's this shift, it's this change in how companies are being designed today, that's the real reason why these companies are dominating, and companies like this will continue to dominate. Now, here's the thing. There's four other companies that you've maybe never heard of or thought of this way that are both this algorithmically driven, and they're also aging in reverse. And so I want to share those companies with you and show you and give you kind of the insight and the clarity which I think a lot of people are looking for. So give me a minute, which in video editing time will be a moment, and let me jump behind the computer and show you what I'm looking at. So give me a second, I'll get there. All right. All right, guys, it is great to have you with me. I am behind my computer now. So this is my weekly investment thought. And the whole purpose of these weekly investment thoughts is to help you become the smartest investor in the room. Now, the image I want to start off with, and I think it's a good image, is the image of bubbles. And the term bubbles and the term crashes is used a lot when talking about investing. But the way I want to use bubbles is how we are each in our own echo chamber bubble because of Google and Amazon and Netflix and Facebook and all the rest of them. Is we have created this kind of this bubble around us that we only now look for information that we already believe to be true at an exponential level. So the idea of bubbles is that we're actually in a sound bubble, and we can only see the things we want to see. And this is one of the reasons why Democrats and pretty much every news anchor was absolutely astonished when Trump won in November, because they had all been in their own bubbles, and those bubbles got popped. So there is going to be a lot of bubbles popping, and it's not because of market valuations. It's because of how so many businesses now that we get our information from are driven by math, and they're aging in reverse. So the first one I want to show you is just Google, which I know is called Alphabet. And the reason they changed or they shifted from Google to Alphabet is because they see the writing on the walls that their company will get broken up. So they wanted to jump in front of that and say, you know what, we're not Google anymore. We're a bunch of different companies. So when it's going to be European policymakers that ultimately break up Google, Google will have already been broken up, right? It will have a parent company, but there'll be all these smaller companies. The reason Google is dominating is because it's mathematically driven. But even more so, the more people that use Google, the smarter it gets. So literally this company is aging in reverse, and this is the price chart you get when you see a company aging in reverse. The next of the four companies, or the four horsemen, is Amazon. They've figured out how to age in reverse too. Every single person that goes on there, especially if they're Prime members, a Prime buyer buys $700 a year compared to a non-Prime buyer, which I believe is $150. I'm making up the 150, but I know it's much lower. The 700 is pretty accurate. Amazon is aging in reverse too, because they've figured out that the more people that use Amazon, the smarter they get and the more they can figure out what to have you buy. So that is the second company. That's why they're dominating, and they'll continue to dominate. Now, unlike Amazon, unlike Google, Amazon will get broken up. I believe it will not be allowed to have $1 trillion market cap company in this country. And when Amazon reaches that, and they'll probably be the first, they will get broken up into different parts. It will happen, guys. Third of the four horsemen is Netflix. Every time you go in and click on something, if you watch a movie for 5 minutes, Netflix knows. If you watch it for an hour, Netflix knows. And because it's a mathematically driven company, it is figuring out, hey, what else should, RC watch based on what he just watched? They are getting smarter and smarter based on math, and they're aging in reverse. They're figuring it out. It's taking them less and less really energy and effort to figure out what to deliver to you. And your monthly subscription is so low that most people don't even think about kind of cutting the subscription because it's such a low fee. And so you'll continue to see companies like Netflix, who age in reverse, continue to grow. And then the four, there could be five, it could be Apple too, but I did not keep Apple in here. Or I did not put Apple in here, is Facebook. They are aging in reverse. The more you use Facebook, the more people use Facebook, the smarter Facebook is getting in delivering you information. So when you go and click on that gold is going to $500 ad, or gold is going to $5,000 ad, Google sees that and says, hey, you know what? Facebook sees that and says, why don't I send him one more gold going to $500 like ad and see what happens? And so Facebook is getting smarter and smarter on what to deliver to you, and it's also aging in reverse. Now, here's the thing. What if those four companies, and it's not the only four companies that are doing it, there are other companies that are doing it. Spotify is doing it, TripAdvisor is doing it, Priceline is doing it, Airbnb is doing it, Waze is doing it, which is now owned by Google, meaning they're figuring out and they're being driven by mathematical equations. What if they weren't the first? What if the idea of this aging in reverse companies, what if these companies have actually been around for a long time, but you've never thought of them as companies? But in fact, that's what they are. And so I want to offer you up four companies that have been around over 100 years plus that are mathematically driven. And every new user that gets added to this, every new user that subscribes to this company gets stronger and stronger, not weaker. There's no depreciation. I want to share these four companies with you because when you really get under the skin and understand what's going on with these four companies, you understand everything and your life changes. So the four companies are the stock market company, the fixed income company, the commodities company, and the real estate company. So look at the first company here. This is a price chart of the stock market company. Now it is the US stock market company, but this company gets smarter with each new subscriber to its business. It is being driven by subscription-based, much more than Google or Amazon or Facebook or Netflix. And every new user makes it stronger, not weaker. There is no depreciation with the stock market company. It is getting more and more powerful. Today, the stock market company market cap is about $22 trillion. Facebook just today passed the $500 billion mark, 500 billion. So this is 44 times more powerful or bigger than Facebook, and it's called the stock market company. The next company is the fixed income company. Looks very different. The subscribers who subscribe to the fixed income company on a monthly basis, they are behaving clearly differently than the people who are subscribed to the stock market company. And in the price chart, you can start to learn what those subscribers are doing with their money. Not what they may do or what they think they should do or what they ought to do or what they fill in the blank do, but what they're actually doing. And it shows up on a price chart of this company. Now, the fixed income company is gigantic, where the stock market company, at least the US one, is about $22 trillion. The fixed income company, think of it as being $33 trillion. It is ginormous. And the more people that subscribe to it, the bigger the subscriber base gets to the fixed income company, the more powerful the fixed income company gets, and the more you can learn about what to do best with your money. And the amount of clarity that can come from understanding these old is the new companies, the more stability and steadiness and consistency you can have in your financial lives. The third of the four companies is the Commodities Company. Again, like the stock market company and the fixed income company, you can tell what the user base is doing and what they feel and what they think. They are putting their money where their mouth is, where their opinion is. These aren't people thinking about doing something. They are actually doing something with their money. And by understanding these new age and reversing companies, these mathematically based companies, you can learn how to get that stability and that consistency and that clarity with your money. And then the last of the four, the real four horsemen of aging in reverse companies, is the real estate company. This is a price chart of the real estate company. This is the US real estate company, and it IPO'd in 2000. You can see what's going on with it. You can look at its user base. You can see what that user base thinks about the future of real estate simply by looking at the price chart of the real estate company. Just like you could do it with Google or Amazon or Facebook or Netflix, you understand what those subscribers or owners of those companies believe about the company based on the price chart and looking at which direction it is going. Now, these real four horsemen are the only four places on the planet, the real ones, meaning the stock market company, the real estate company, the fixed income company, and the commodities company. Those are the only four places on the planet you can put your money, and you are always invested in one of those, if not all of them. If you have cash, cash is a fixed income that pays a zero interest, that yields 0% interest, and has what would appear to be zero price volatility. But let's just go with that right now. I don't want to open up that can of worms. But cash is a fixed income. So there are four places on the planet you invest your money. As soon as you make a dollar or a yen or a yuan or a euro in your life, you are fully invested in one of these four places. And it's knowing how these four interact with each other that you can start to understand how the money is flowing between them. And that's where you can really get the clarity of what to do best with your money. And that's in fact what I do at my research company. And that's what people buy from my research company is they look at the results of how these four aging and reverse companies operate amongst each other relatively. So we know with clarity where money is flowing, where stability is, where consistency is, and where steadiness is. Okay, so what's the takeaway? The takeaway is, guys, find companies that age in reverse. I think the four best companies you can understand, and when I say find, it doesn't mean invest, but find them and then understand how they kind of interplay and work relative to each other. And once you have that, you have everything. And then lastly, and I think you're going to find this, when you find companies that age in reverse, you're also going to find companies that are driven by mathematics. And the stock market company and the fixed income company and the commodities company and the real estate company are all driven by math, and they're all aging in reverse. And it's understanding the connection between those four and how you're always in one of them is where the true clarity and freedom and stability comes in your life. Guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, if you like this or even love this information, please share, like, and forward to people you know because it makes a difference. And look, you belong here, right? You belong here if you want investment stability, but you're tired of the hype and the BS, right? Let us help you become the smartest investor in the room so you can stop drowning in the drama and the distraction and your own built echo chamber, hall of mirrors, and get the principles for free. You guys are great. Thank you so much for being in my world. And if you are not already in my world, please upgrade your investment peer group by getting into or getting on my list. You guys are great. Thanks so much. I'll speak to you next week.